traders, this is Robb Reinhold. This is the trading room. We are done with April monthly options expiration. We will be doing the accounting on Monday. We'll be sending out distributions on Tuesday, and then Wednesday is level advancements. But that month is done. We got to go forward, so let's take a look at the next month. In this session, we're going to talk about what happened this week. We'll take a look at the broad markets. Then we're going to score everything from +3 to -3, the markets, the sectors, and as always, we're going to look in those sectors to find the best longs, the best shorts, and the best sideways trades.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
The April monthly options expiration ended on a very down note, and the markets have been pulling back really for the last 2.5 weeks. And where we were on last Friday was we were right at the 50, and we said we are on the edge of a cliff. If we bounce here, we're safe. If we fall off, it's trouble. And I said last week, by Tuesday we'll know. And sure enough, by Tuesday we knew that the rout was on. And pretty much any rally was sold. And we're going to take a look at the candles of last week and just show you just how bad it was. All risk-off assets were bought. So gold is trading at a new high. The bonds are trading up. Pretty much anything people do when they're scared, that's what they went out and bought. And of course, we all know that some of the tensions are happening in the Middle East. This is what the rush to safety is probably about. Look, we had a big run. We've had, interest rates go higher. We've had the Fed come out and say they're going to do less cuts. And now we've got this Israel-Iran tension going. People are just selling and taking profits from the big run. Last week, I really want to point out one report, and I feel like this report just set the week off for a down week. This retail sales number was stunning. That was a really big number and just crushed the estimates. And this pretty much made it to where any hope of the Fed cutting rates in the next month or two were pretty much gone. And we now see only an 18% chance of a rate cut in June. Last week it was around 30. This report is super strong. It says the economy is doing great. Fed is not going to cut rates if the economy is doing fantastic like this. Other than that, we had a strong Philly Fed number as well. Again, just a strong U.S. economy overall, stronger than the Fed wants. So it means higher interest rates. Let's go ahead and take a look and see what happened this week. As I said earlier, a bunch of stuff are happening all at once. Higher interest rates. We've got some earnings stories coming out. Netflix missed earnings badly on Thursday. We've got all these tensions in the Middle East. There's a lot going on at the moment. And so, as I said, people are just simply selling. The Dow was flat for the week, but S&P down 3%. Look at the Qs, down 5.4%. That is a huge down week. The Russell down 2.2%. Oil down 4%. Gold up 2%. If we take a look at these charts, this is what I really want to focus on, because last Friday we were here. Take a look at last Friday, we were right here, and we said, hey, we're on the edge of a cliff. I want to show you just how bad the candles were this last week. We got gap ups, so we gapped up on Monday, sold off all day long, closed at the lows. You can see there's a tiny gap up here, a little run in the morning, selling off, closing down near the lows. Another gap up, selling all day long, close down near the lows, a gap up again, a little run up, selling, closing down at the lows, and then not even a gap and just selling. These are bad candles because what it's showing you is that any little bit of bullishness was just being absolutely hammered on. And there's way more sellers out there right now than buyers. The buyers are trying to make little rallies, but they are just overwhelmed by the end of the day by the sellers. This has been a big move down. There's likely a bounce happening here, but I wanted to really be clear because we have, in past bull markets, we have seen what we call a pierce. And now a pierce means that the market breaks below the S&P for like a day or two, and then it rallies right back up and is solidly above that for the rest of the time. We did not see that. There is no pierce here. This is not a pierce. We are now clearly below the 50-day moving average, and any rallies we have are likely to be sold into. At this point, we are in a bearish market. We are making lower lows, lower highs, and just like we did when the market was bullish for months and months and months, we said, hey, look, once the market changes, we'll change. But until then, we're going to stay with the trend. We have to do the same thing on the downside now. We have to do the same thing, and any rallies should be opportunities to get into some bearish positions until the market tells us that it's no longer bearish. We take a look over here at the Qs. This looks even worse. This is an absolute disaster here. Yes, we have gone a long way in a short period of time. There could easily be a rally next week, but I think it is another selling opportunity in this market. With that being said, I want to also be realistic here. One of the things that we are seeing is we're seeing the big ones be taken out and shot. Now, granted, those were the ones that led us in January, February, March, and it was a fairly narrow rally, and now it's a fairly narrow sell-off. As you can see, there's plenty of green out there. I mean, look in financials, look in the consumer defensive, look in utilities. Again, these are defensive stuff, but there is some buying still out there. But the red, the intense red in the large cap tech stocks, that's why the markets are going down so much, because these are a huge percentage of the market. One thing we do have to talk about, and I'm going to pull out a chart here in a second, talk about how these bear markets work. So again, the market's bearish. There's a rally likely going to happen here because we are a little extended here. It is a selling opportunity to sell into to take some bearish positions. However, let's be realistic here. This is likely a shorter term bearish move. I'm going to pull out a longer term S&P chart, and we're just going to look through the times that we broke below the 50-day moving average. Now I'm going to switch to a weekly chart just so we can get some perspective here. That weekly is not going to work. Sorry, I got to go back to a daily because that's going to change our moving averages. What I want to do is I want to see when we did cross below the 50-day moving average, how long did we stay bearish? Here's the last one that happened, August to October. So that was about 2.5 months. If we go back here, we broke below it. This was literally a month. There was a month of time where we were below the 50-day moving average. Come back here. This one was about 3 weeks. This one back here, this was closer to 2 months. 2 months of time. So there's been plenty of times where we do break below them. Here's one here, broke below it. That one lasted for about 4 months. This one here, about 3 months. This one here, about 1 month. What I'm trying to show you is that this happens. This happens periodically in markets. And if it's not a bear market, sorry, let me say that again. If it's not a recession, then the moves are likely short and sharp, typically lasting 1, 2, 3, maybe even 4 months. But if we go back, now I'm going back into the 2010s, and you can see a move here that was done in a month. A crash down here, done in about a month. This one, about a week. This one here, much more substantial. This one was 3 months. I want everyone just to see that these things do happen. And when they happen, they're short and they're sharp, and we have to get bearish. But we need to understand that these typically do not last long. The only time they last long is when we are into a recession. And that's when they can last 10 to 12 months. That's the length of an average recession. But just go back in time and just go back and see that we've had these breaks. 2015 broke here. Really, that's like 3 months it recovers. Break here, recovers back in 3 months. Look, they are short, they're sharp, they're painful. There's good money to be made in them, but we have to understand that they are shorter term in nature. The only time when they are typically longer term in nature is when there is a recession in the economy. And I want to go back to last time there was a recession. This is 2011. This is when the US got downgraded. This one was very substantial, but it lasted, 3 months. I'm going to get back to 2008, and then we'll go on. This is where it's dangerous. This is where it goes down and stays down for a very, very long time. And we could go back to the last time there was a recession, which was before this, which was 2001, and we'd see the same thing, where it drops and drops and drops for a year, maybe a year and a half. So the question is this where we are? Are we entering recession here? Or is this going to be one of those 2 to 3 month long, maybe 1 month long, short, sharp, painful sell-offs that ultimately recovers and is bought? There's no data out there that says that we are heading into a recession here. Of course, black swan events can happen, but I want you to all be prepared. First of all, you do need to be bearish. There's no reason to be bullish here anymore. But we need to understand that it's likely to be shorter term in nature until we go back to a more bullish market, or at least a sideways market. I know that took up some time, but I really wanted to go through that because that is something we all need to know. When I was a young trader, I started trading in 97, and when I saw the market break and crash in 2000, and it went down for like a year and a half, I thought, oh, that's what happens in pullbacks. That's what happens. And it really set me up to miss out on lots of bull runs over the next couple of years, because I thought when the markets, quote unquote, broke to 50 or broke down, that it was going to be a year long. And that is just not the case. Let's take a look at what's on the schedule. There's not much on the schedule until Friday. Friday, we get the core PCE price index. This is probably going to be the most important thing of the week, and it's supposed to come in as expected. The CPI has been hot, but this number has not been hot. This number has been pretty tame. This might soothe the markets a little bit, but we'll just have to wait till Friday to see. We are at a -2. That's just where we are. This means we want to have more bearish trades than bullish trades, but the time frame, we have to be very conscious about these bear market moves. They are short and sharp. You can make a lot of money in them. I love bear markets. I love them. But I've come to understand that they are 6 weeks long, 8 weeks long, 3 months long. They don't last forever. And at some point, I've got to get back on the other side of the trend when the chart shows me it's time. Let's go in and take a look at the sectors. The sectors are really telling you a great story here if you listen to them. Taking a look at the performance, as you can see, tech, consumer absolutely obliterated last week. Tech down 6.27%. Real estate, also, we've been the most bearish on real estate, and it just continues to fall. Let's point out what didn't go down. Now, utilities didn't go down. I'm going to discount that because utilities are a defensive sector. Healthcare did not go down. Healthcare is a defensive sector, so we would expect these sectors to do better. Now, real estate is also sometimes considered a defensive sector, and you can see it got absolutely crushed, so it is not acting like a defensive sector at the moment. Financials up for the week. Pretty much all the big banks have already had earnings, and the earnings were mixed but good enough for them to completely shrug off this huge sell-off this week. That's telling you where the strength is. Materials and energy, down 1%, only down 1%. So they went down like everything else, but really held on. This is where we want to focus on our longs. This is what's showing some strength. Now, yes, We can look at utilities and healthcare as well, because if the market continues to fall, those sectors probably will do better than the rest. Consumer and tech look horrible here. They look horrible. That's where you should definitely be focusing on some shorts. Let's go in and score everything from +3 to -3. Utilities was a +2 last week. It had a dip. But boy, look at the buyers come into this really nicely. And it's actually looking better as a +2 this Friday than it did last Friday. So +2 on utilities. Communication services, we're holding up nicely. Here we were last Friday. We had just downgraded it to like a +1. And you can see just a huge move down on Monday. Held in okay. This isn't the worst sector in the world. It's just not great. It's a -1. It's not the best, not the worst. Now let's talk about the worst. Look at this real estate sector. Absolutely terrible. We were at a -2 last week on real estate. Clearly a -3 here. We have broken down and we're just basing down here to low. So -3 on real estate. Healthcare next. Healthcare was also a -2 last week. Look at those candles. Healthcare gapped up every single day. Every single day it gapped up, sold off, gapped up, sold off, gapped up, sold off. If it wasn't for the gaps, this sector would have been down 2 to 3%. This is not good price action, but it is what it is. We're down here at a base. It's probably likely to have a bounce like everything else, but still, this is a -3. It went from -2 to -3 last week. Industrials have been one of my favorite sectors. This whole year, industrials, to me, was one of the best, along with energy. And, last week we had to downgrade it. We had to downgrade it because it broke through the 20. Gap up on Monday and just sell off. At this point, it is no longer a sector that I can like on the bull side. It's just not. Technically speaking, I have to now be more bearish than bullish in the industrial sector. Financials, we're a -1 last week, and we're going to keep them at a -1, basically flat on the week. There was buying on Friday. Remember, Friday was such an ugly day. There were buyers, and we actually closed closer to the highs on Friday. So this, to me, you can't be bullish on financials, but you definitely can be not bearish. This is where looking for zeros and -1 type trades, this is going to be a really good sector for those. Here is consumer discretionary, absolute disaster of a chart. You could see there is no buying coming into this by the end of the week. None whatsoever. It's a solid -3. Tech, same thing, absolute disaster, -3. Okay, these sectors have moved a lot in a short period of time. Will they likely bounce? Yes. Those bounces should be good opportunities to enter new bearish trades in these sectors. Those two sectors by far look the worst to me. Coming over here to the material sector. All right, so we had to downgrade the material sector once it broke here. As you can see here, ugly day on Monday. But for the week, after Monday, just Tuesday through Friday, it was flat. Now look, these aren't great candles. I expect it will likely fall next week if the market continues to go down, but it's not the worst. It's not in free fall like some of the others. It actually held in fairly well. And let's finish this off with energy. Energy, we have to downgrade it. It was a +3. But you can see here, we got some buying. We got some buying coming into it on Friday. I don't think we're going to see new highs here, but I could easily see us stay up in this area in the energy sector. Here's where we were last week. And we talked about how we have some sectors, energy, utilities, comm service, industrials, really hanging in there nicely. And then we had real estate, consumer, healthcare, tech were terrible. Well, guess what? Those got worse. Those got worse. Everything that was below zero got worse except for financials. Financials hung in there. We also have to say goodbye to comm services and industrials from the bullish side. They are not as bearish as the four worst sectors, but they are still pretty bearish here. And then we do have to downgrade energy from a +3 to a +2. As you can see here, it's saying to be more short than long, just like the market is. Focus your shorts on tech, consumer, healthcare, real estate, and I think you can throw industrials in there too. Energy utilities, you can't be super bullish them, but you can be mildly bullish and look for some sideways stuff in financials and materials. So let's take all that information and let's go look at some possible trades in some of those sectors.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
First up is utilities. This is Dominion Energy. Now this is a trade we had in the trading collective that expired on Friday. And you can see that it is breaking out here and looking to make a really nice run potentially over the next couple weeks. So this is a utility company, so there's only monthly options. So there's not a lot of choices that you can make. You can basically look at the May 17th, 50, 52, 50 bull call spread, or you could take a look at the pretty much at the money butterfly. I like the 50, 52, 50 spread on this, but it is going to have to move higher. You're asking this to move higher in a market that doesn't want to push many things higher. If there was a better trade to make, I mean, you could make the 47.50 50 bull call spread. You're probably going to have to pay about 70% of that spread. You could make that a +1 trade, but I think you're pretty limited to that 50, 52, 50 on Dominion. But this chart looks absolutely fantastic. Healthcare is a sector that I want to be more short in. Coming across CVS Health. Here's what I like about this one. Bad earnings report or bad news, something happened. It fell, it couldn't rally. It broke, and now we're doing basically the same thing. Take a look at this day. Huge gap up. Totally lost all the gain by the end of the week. This one is not falling right here, right now. So if you're looking for something to okay, what is falling the most? What's falling hard right here, right now? This is not it. This is basing. So I think you've got to take a look at this and be realistic on your time frames. If you are looking just to do a 1-week trade, the April 26th, 71.69. So we're basically saying 71 down to 69. As you can see here, we're not asking this to be all that bearish. We're saying, hey, just be below 69 by next Friday, and that'll be a max gain. If you want to go out one more week to get a little bit more bearish, then look at the 70.68 spread. As you can see here, we're not asking this one to be super bearish because it's just not happening right here, right now. I also want to point out, look at the trades. 1 week, 2 weeks, expecting this move down to be short and sharp, but not last for months and months and months. We don't have a ton of time on some of these bearish trades because we took a look back over almost 15 years of history and saw that these moves below the 50-day moving average, if there's not a recession, typically last anywhere from 1 to 3 months. Let's go into financials next. This is a sector I really like, and this chart looks absolutely phenomenal. This is Schwab, and someone forgot to tell Schwab that the market was having some trouble this week. We did pull back. Buyers came into it. Look at all the candles this week on Schwab compared to everything else. It looks fantastic. Looks great. Question I have is how much upside does it have in a market like this? And my answer is not a lot. This is why I love diagonal call spreads in these situations because I'm looking at this one, the 70, 74. So go out to the May 17th, 70, and you're going to sell the 74, which is pretty much at the money. So that's going to be a diagonal call spread. It's going to look like this, 74. And you can see here, as long as this thing doesn't go down substantially, it's great. If it takes off and runs, okay, you made a little bit of money, that's it. But it's a 1 week trade. Next Friday, you look at this and you say, hey, do I want to close the whole thing out? You know, if it's trading at 74 and looking good, hey, let that thing expire and just hold on to the May 70 calls. See if it can break out and run next week. This one gives you a lot of stuff you can do. If you want to do a vertical, then I think the 72.74 is your trade here. Now take a look at these trades. May 17th, May 3rd, giving these trades more room. So bullish trades, any new bullish trades, I'm looking to give them more time than I'm giving my bearish trades. Because again, we look back at the history, these moves are 1 to 3 months long. We're a couple weeks into it. Anything that we do bullish, let's give it some more time just because of that reason. Consumer is one of my favorites for shorts. And originally I came across Tesla as the best looking short. Tesla chart looks terrible. And I always get a little nervous when I come across like Tesla, Microsoft, Nvidia, because people just gravitate towards those and trade them because they think, oh, they're popular. And I really hesitate those trades because I'm wondering, am I falling into that same trap? Because look, everything is just a symbol and everything moves up and down. There's no way that Nvidia is always the best chart to trade. But some people just trade Nvidia and Microsoft and others, totally ignoring everything else. It's a bad habit to get into. So originally I'm like, okay, Tesla looks good. And I looked inside of the industry group at other EV makers, and this one looks even better. This is Li Automotive, LI. And you can see this thing is falling and falling hard. We have broken through support, and the next support is down in the low 20s. This thing's at 26. So low 20s means there's potentially a 20% drop here on a trade like this. If the market stays bearish, and again, everything is bearish, this thing should drop substantially. I think this is one of those times where you could look at puts. That is the wrong puts, not the 12 puts. You're going to want to do the 29 puts. This is, again, I'm not a big fan of long calls only and long puts only, but in certain situations, I think you can pull those out and make a trade like this. If you want to just do a vertical trade, same thing. Let's keep them short term. Let's keep them short term. Let's keep them close to the money. So again, the 27.25. Just asking it to go down a little bit more, or go out to May 3rd, go 26.24. Have it go down a little bit further here. Shorter term on the bears, longer term on the bulls. That's what we're looking to do. And last in the energy sector, CVE, Synovus Energy. Beautiful run. I mean, look at this buying. This buying is institutional buying. What this means is that people are just sitting out there on the bid all day long, buying any shares that are sold for months and months and months. That means that there's a lot of orders out there that need to get filled. Yes, we had a big pullback after a substantial run. It found support right where it should. Look, these candles aren't great, but think about the week we just had. If this week was an up week, I bet all 4 of these candles would have been nice, solid green candles and likely back up to the high of 22. We had a terrible week this week, and we still were able to make some bullish candles. I think you want to be less bullish on everything here. So I think diagonal call spreads make a lot of sense here. The May 17th, 19, and then you'll sell the 21. I mean, that is like at the money. That's just at the money for 1 week. If it takes off and runs, you only make a little bit. But if it hangs out in here, hey, you've got a nice trade on your hands. You could do the vertical, go out to May 10th, 2050, 22 on the upside. I don't think you can say it's going to break out to new highs and run. It could, but this is not the market that is rewarding lots of stocks with new 52 weeks highs. I think you have to be a little bit more realistic with your longs here. If you want to share any of your trades with the rest of the Maverick group, go to the website, log in, go to the members area, jump into that forum. We love to see our traders working together. Let's go ahead and wrap this up. The markets are bearish, period. You may not want them to be. You may have had bullish positions. Now look, I had a losing month this month so far. And if you take a look back on pretty much all my years of trading, I usually have 1 or 2 months that are negative. And those months are typically months where there's been a trend change. I am a absolute adherent to trend following and trend trading. And so when the trend is going, I do very well in trading. When the trend changes during that month, yeah, that's a loss. It takes a loss. That's fine. I know that's going to happen to me. I'll just get on the bearish train until that's over. And guess what? When that changes, I'm probably going to take another loss too. I'm okay with that because we get about 2 to 3 trend changes every single year, and the rest of the time, it's solidly trending one way or the other. You're going to make plenty of money in the good months, so just stick with the trend. Once this market stops being bearish, we'll go back to being neutral or bullish. We're just going to follow what the charts do. Again, don't expect this down move to last for months and months and months and months. We're just not there. Unless, look, something could happen. If something like escalates in the Mideast and gets a lot worse, sure, this can turn into something different. But for the data we have right here, right now, the data does not say this is going to be a protracted bearish move. Likely to be short and sharp, painful to the bulls, but likely to be short term. Of course, we're always looking at new data. Next week, we might get new data that tells us something different. But for right here, right now, that's what the market is. And we have a saying at Maverick, trade the market in front of you. Not the market you think it's going to be, not the market you think it should be, but the market that's literally right in front of you. That's how you make a living in trading. Everyone have a great weekend. Goodbye, everyone.